Hey everyone, welcome back. We're diving into a question that I'm sure is on a lot of our minds. How to get rich, specifically in your 20s.
Mm-hmm.
You know, a lot of you have been sending in this YouTube video by Mark Tilbury, who claims he's got this roadmap to becoming a millionaire, even if you're starting from zero in today's world.
Right.
So we're going to break down his 6-step plan, highlight the most important parts, and see if his advice actually makes sense.
You know what I find really interesting about Tilbury's approach is he frames it as this challenge. Like, imagine you're 16 again, but this time you've got all the knowledge and experience you have now. Could you build wealth faster the second time around?
Oh, that's a cool thought experiment.
Right.
Yeah, it makes you think about what choices you'd make differently, knowing what you know now. So step 1, he starts off simple. Get any job you can to start generating income, then immediately launch a side hustle.
Yeah.
What do you think about that?
I think it's more about mindset than anything. You know, don't get stuck in that just a job mentality. Use that income as fuel for something bigger. He talks a lot about drop shipping as a good option.
Right, drop shipping. For those who aren't familiar, it's like being the middleman without actually having to deal with any inventory. You partner with a supplier, list their products on your website or social media, and when a customer buys something, the supplier ships it directly to them.
Yeah.
He does mention, though, it's not some magical get-rich-quick scheme.
Definitely not. And this is where I think Tilbury's advice gets a little too simplified. He kind of glosses over the fact that dropshipping requires a whole bunch of skills. You need to know about marketing, creating ads, building a website, writing copy, even basic design. It's essentially running a business, even if you're not physically handling the products.
That's a good point. It sounds easy in theory, but there's definitely a lot more to it than meets the eye. Okay, you're hustling, bringing in some cash from your job and your side gig. What's next?
Well, Tilbury says the next big thing is to avoid what he calls lifestyle inflation.
Ooh.
Which I think we've all experienced at some point.
I know I have.
Right. As soon as you start making a bit more money, it's tempting to upgrade everything. A nicer apartment, a fancier car, that designer bag you've been eyeing. Tilbury's a big advocate for budgeting and being strategic with your money.
Mm-hmm.
It's about delaying gratification and putting your money to work for you instead of just spending it on immediate wants.
He's not just talking about saving for a rainy day, though, right?
No. He lays out 3 main uses for your income. First, build an emergency fund. He suggests having 3 to 5 months worth of living expenses stashed away. Second, start contributing to a retirement account, even if it feels like a lifetime away.
Retirement at like 20-something? That seems so far off.
I know, right? But he argues that starting early is key because of the power of compounding. Basically, the money you invest now has more time to grow exponentially. And his third tip is to invest in low-cost index funds like the S&P 500.
Okay, hold on. For those of us who aren't finance experts, can you break down index funds for us? Why are they such a good option, especially for someone just starting out?
Sure. So think of an index fund like a basket of stocks that tracks a specific market segment. The S&P 500, for example, tracks the performance of 500 of the largest companies in the U.S. It's considered relatively low risk because you're diversifying your investment across a large portion of the market, and historically, the stock market tends to go up over the long term.
Okay.
They're generally much less volatile than individual stocks and can offer pretty good returns over time. Plus, the fees for index funds are typically much lower than those for actively managed funds.
That makes sense.
Yeah.
So you're working side hustling, budgeting, investing. It feels like you're already doing a lot.
Right.
But Tilbury doesn't stop there. He says step 3 is all about your network. He's a big believer in ditching negative influences and surrounding yourself with people who are driven and supportive of your goals.
And he doesn't just mean hanging out with people who are already rich and successful. He really stresses the value of finding mentors, people who have experience and can offer guidance and advice based on their own journeys.
That's a great point. And in today's world, he suggests using social media to your advantage, both for networking and building a personal brand.
Yeah, he's got a point. Sharing your journey online can help you connect with like-minded people, attract opportunities you wouldn't have encountered otherwise, and even build credibility in your field. It's like a modern-day apprenticeship in a way.
I like that, the modern-day apprenticeship. So you're building your network, refining your skills. But what about money management? Tilbury has a somewhat controversial suggestion. Get a credit card at 18. That seems a bit risky, doesn't it?
It can be, but he makes an interesting argument. If you use it responsibly, a credit card can actually help you build a good credit score, which is essential for getting favorable loan terms later on, whether it's for a car, a house, or even starting a business.
But how do you use a credit card responsibly, especially when you're just starting out and everything seems so tempting?
He emphasizes that a credit card should never be used as a free pass to overspend. Only buy what you can afford. Pay the balance in full each month to avoid interest charges, and treat it as a tool to build credit, not a way to fund an unsustainable lifestyle.
So it's all about being smart and disciplined with your credit. Okay, so you're making money, building your network, managing your credit. What's next on Tilbury's roadmap to riches?
Well, once you've got some experience under your belt, he says it's time to think bigger. He suggests focusing on building a scalable business.
What exactly does he mean by scalable?
He's talking about a business that has the potential to grow rapidly without being limited by your time or resources. He seems to be particularly keen on online or software businesses because they often have lower overhead and can reach a much wider audience.
So instead of trading your time for money, you're building something that can generate income, even when you're not directly involved in the day-to-day operations.
Exactly. And to do that, he highlights a few key points. Identify a gap in the market, move quickly to establish yourself before competitors catch on, and reinvest your profits back into the business to fuel further growth.
So you're not just creating a job for yourself. You're building a system that can generate wealth more passively and potentially on a much larger scale.
That's the idea. And this is where I think Tilbury's advice starts to get really interesting.
Ooh, I'm intrigued. Tell me more.
Well, once your business is up and running, he lays out a specific investment portfolio allocation. But I think we should save that for part 2.
Okay, cliffhanger. We'll be back soon to break down Tilbury's investment strategy. Don't go anywhere. Welcome back. Last time we were talking about Tilbury's roadmap to riches, and things were getting really interesting.
Yeah?
We left off on kind of a cliffhanger with his investment strategy. So once you've got your business thriving, where does he recommend putting your money?
Well, it's a pretty diverse portfolio, actually. He suggests a good chunk, 50% to be exact, goes into real estate.
50%? That's a lot. Is he talking about, like, buying your dream home?
Not exactly. He's mainly focused on rental properties. He sees those as a solid way to generate consistent passive income through rent, while also taking advantage of potential property value appreciation.
So you're making money from the rent, and the property itself could go up in value over time. But real estate seems like a pretty big investment. That might be intimidating for someone in their 20s, even if they've been following all of his steps so far.
You're right. Real estate's not cheap. Tilbury emphasizes doing your research and being strategic about the properties you choose. Location is key. He suggests looking at things like school districts, local income levels, and the overall growth potential of the area.
So it's not just about buying any property. It's about finding one that's likely to attract good tenants and increase in value over time.
Yeah.
That makes sense.
Exactly. And he even mentions the rise of platforms like Airbnb, suggesting short-term rentals as another avenue to consider.
Interesting. So he's really bullish on real estate, even comparing it to things like classic cars as investments.
Yeah, he sees it as a tangible asset that can provide both income and potential appreciation, which is a pretty attractive combo for a lot of investors.
Makes sense. But real estate is just one piece of his investment pie.
Right. Right. He also recommends putting 25% into low-cost index funds, specifically the S&P 500.
We talked about index funds a bit earlier, but remind us why he likes them so much.
Yeah.
And why the S&P 500 in particular.
He's all about riding the overall wave of market growth. And the S&P 500, which tracks 500 of the largest U.S. companies, is a solid way to do that. It's a relatively low-risk way to tap into the stock market's potential, especially over the long haul.
So it's like investing in a slice of the American economy.
Exactly.
It might not be as exciting as picking individual stocks, but definitely sounds more stable.
Yeah.
What else is in this investment mix?
Next up is retirement accounts. He recommends allocating 10% to those.
Retirement, I know we touched on this before, but honestly, when you're in your 20s, retirement feels like forever away. Is it really that important to start thinking about it so early?
Tilbury says it absolutely is, and I agree with him on that. He really emphasizes the power of compound growth over time. The earlier you start, the more time your money has to potentially multiply, and the more comfortable your retirement years will be.
It's that snowball effect.
Right.
The earlier you start, the bigger it gets. Okay, I'm starting to see why that's important. But what about something a little more, well, exciting? Does he have any suggestions for investments that might appeal to someone who's a little more adventurous?
He does, and this is where I think his entrepreneurial side really shows. He recommends allocating 12% to angel investing.
Angel investing, like what they do on Shark Tank, Seems kind of out of reach for most people.
It might seem that way, but it's becoming more and more accessible. It involves investing in promising startups or early-stage businesses. You're not just giving them money, you're often offering mentorship connections and expertise to help them grow.
So it's like being a mini venture capitalist,
Yeah.
helping to shape the next generation of successful companies.
Well,
That actually sounds really cool. But that'd be pretty risky too, right?
yeah. True. It is higher risk, but the potential rewards can be higher too. And that's why he only suggests allocating a portion of your portfolio to it. But for someone in their 20s who's got that entrepreneurial spirit, it could be a really exciting and potentially lucrative option.
Okay, so we've got real estate index funds, retirement accounts, angel investing. Anything else?
2 more categories, both with smaller allocations. Individual stocks at 2.5% and cryptocurrencies at a very conservative 0.5%.
Let's talk about stocks first. What's his reasoning there?
He considers this your play money, the funds you're comfortable taking bigger risks with. Allows you to explore specific companies or sectors you believe in, even if they're more volatile.
So if you've been following the market and have a hunch about a particular company or industry, that's where you can take a bit of a gamble.
Yeah.
What about crypto? That one seems super risky, especially with how much the market has been up and down lately.
He's definitely cautious about crypto. He specifically recommends sticking to well-established ones like Bitcoin and only investing what you can afford to lose completely. He recognizes the potential for big gains, but also really stresses the importance of understanding the risks.
It's like dipping your toes into a really choppy pool.
Yeah, exactly.
You might come out feeling great, or you might get wiped out by a big wave.
Good analogy. It's important to remember that crypto is still relatively new and unpredictable. It's not for everyone.
Definitely not.
No.
But it seems like the overall message Tilbury's sending with this portfolio is diversification.
Absolutely. He's basically saying don't put all your eggs in one basket.
Right.
By spreading your investments across different asset classes, you can potentially maximize your returns while also managing your risk. It's all about finding the right balance for your own risk tolerance and financial goals.
So we've covered a lot of ground here. What are your biggest takeaways from Tilbury's investment strategy? What should our listeners be thinking about as they consider their own path?
Well, I think the key takeaway is that building wealth isn't just about making money. It's about being smart with how you use it. Tilbury's advocating for a balanced approach that combines long-term thinking with strategic risk-taking. He wants us to be active participants in our financial futures, not passive bystanders.
I like that. It's about taking control and making informed decisions instead of just hoping for the best.
Exactly. But I have to say, Tilbury's roadmap does seem pretty intense. Is it really realistic for someone in their 20s to juggle a job, a side hustle, manage their finances, build a business, and on top of all that, figure out investing?
It's a lot.
It is. But that's where I think Tilbury's message about mindset comes in. He believes that with the right attitude and a willingness to learn, anyone can achieve financial success no matter where they're starting from.
It's inspiring, for sure. But we're not quite done yet. There's one more piece of Tilbury's advice we need to unpack, and we'll get to that right after the break. All right, we're back for the final part of our deep dive into Mark Tilbury's roadmap to riches. We've talked about side hustles, budgeting, building a business, creating a diverse investment portfolio. What's this last bit of advice you mentioned?
Well, it's not so much a specific step as it is kind of a theme that runs through all of Tilbury's advice. The importance of mindset.
Mindset. Okay, we hear that a lot these days, but what does that actually mean when we're talking about building wealth?
Tilbury believes that your mindset is really the foundation for everything else. It's about cultivating a belief in yourself, in your abilities, and your potential to achieve financial success.
So it's not just about having a positive attitude. It's about believing you can actually reach your goals, even if they seem really hard right now.
Exactly. And that belief turns into action. It's what pushes you to get that job, start that side hustle, stick to your budget, invest wisely, and keep going, even when things get tough.
He talks a lot about not being afraid to fail, right? Seeing setbacks as opportunities to learn instead of giving up.
Yeah, that's a big part of it. He wants people to embrace those challenges, get out of their comfort zone, and constantly learn new things.
It's like having a growth mindset, believing you can always learn and improve no matter where you're starting from. But honestly, sometimes it feels like there's just so much information out there, so many different opinions about how to get rich. It's overwhelming.
I get it. The world of finance can feel pretty confusing. But I think that's where Tilbury's advice about mentors and building a strong network is really important. Surround yourself with people who are on a similar journey, who can guide you, share their experiences, and help you figure things out.
So it's not just about learning from experts. It's about finding a community that can support you along the way.
Right. And don't forget about learning from your own mistakes. Tilbury's pretty open about the mistakes he's made and how those have shaped his approach to business and investing.
It's nice to hear someone who's successful be honest about the rough patches. It makes it feel more realistic, like anyone can do it.
Exactly. And I think that's what makes Tilbury's message so powerful. He's not just giving you a formula, he's trying to inspire people to take charge of their financial future and create a life they truly want.
So what does all this mean for our listeners? What's the one big takeaway they should remember from this deep dive?
Well, Tilbury's roadmap is a good starting point, but at the end of the day, everyone needs to find their own path to wealth. It's about taking those key ideas, working hard, smart spending, strategic investing, always learning, and having a resilient mindset and applying them to your own situation and goals.
I like that. It's not one size fits all. It's about figuring out what works for you.
Exactly. And remember, getting rich isn't a race. It's a journey. There will be ups and downs, but with the right mindset and a commitment to growing, you can achieve financial freedom and build a life you love.
That's a perfect way to wrap things up. Thanks for joining us on this deep dive. We hope it's given you some good insights and motivation to start building your own path to wealth. And remember, the best investment you can make is in yourself.